Hello. It seems that the Labor Party will announce next week some details of a proposed capital gains tax for New Zealand, assuming they take office at the end of this year. Before I comment on this proposal, it's important to just remember that no details have been released yet, although that said, there's a strong rumour around an exemption for personal residents and a 15% capital gains tax rate. In the clamour that's arisen already on this proposal, its supporters seem to be putting forward four principal claimed advantages. So I'd like to just go through and analyse those one by one. The introduction of a capital gains tax will mean that it won't be necessary to sell state-owned assets in order to fund the rebuild of Christchurch and the long overdue upgrade of the Auckland infrastructure. This is the first advantage that's been put forward. Now, ignoring the philosophical arguments on should the government own those assets in the first place, there is a very important issue, an issue that the politicians seem not to understand very well. It's a matter of cash flow timing. The so-called experts point out to us that a capital gains tax can take 10 years to come up to speed, and when you think about this, it's easy enough to understand the probable correctness of a contention like that, and I'll go into that shortly. After all, no one likes to pay tax, albeit that they may well accept that it is necessary. Some people, if they own a capital asset which is likely to be subject to a capital gains tax, then it's natural that they will hesitate before they sell that asset. International experience suggests that it's only as the current owners of assets begin to die that the capital gains taxes become payable because they've kept the asset. In other words, what we wind up with is a kind of de facto estate duty. The Prime Minister has commented on the apparent inconsistency in the figures being put forward to support the capital gains tax. And whether he be right or whether he be wrong, the reality is that the money from this proposal is needed right now in the case of Christchurch, and the sooner the better in the case of Auckland. It seems extremely unlikely that the rate at which the new tax is collected will get within the proverbial bull's roar of when it's actually needed. So, to me, it seems that this so-called advantage is merely a selling feature and not a justification at all. The second so-called advantage claimed for capital gains tax is that it will enable the government to reduce income taxes. Now, ignoring those timing aspects I've just talked about, the intellectual debate here is about whether the incidence of tax, the intellectual debate is about where the tax falls, and of course, where it should fall. There have been concerns that for some time, far too much of New Zealand's requirement for tax revenue is being funded by far too few of the people of New Zealand. The recent tax working group, sponsored by the government, made this point graphically and at length. They also suggested a number of measures that could broaden New Zealand's income tax base, one of which was a capital gains tax. Now, the government looked at the issues associated with each of the alternatives that the tax working group put forward, and they chose the alternative of increasing the GST rate from 12.5% to 15% instead of the capital gains tax. So in a way, it can be said that the problem has already been dealt with that GST rate increase. As an aside, the danger for New Zealand is that the too few people who carry the burden of the tax being collected by the government will, and indeed in the past have chosen, to leave New Zealand on a permanent basis, inevitably for somewhere with a more equitable tax regime. Now, this is the beginning of a downward spiral, a very dangerous downward spiral, with fewer and fewer people being required to shoulder more and more of the burden. So, of course, greater incentive to leave, suicidal even. Having said that, the question remains, will the government, whichever government actually use any revenue from capital gains tax to reduce income taxes when, note, one of the declared purposes, or so we're told, is capital development and infrastructure spending. Now, you can't have your cake and eat it too. Not for the first 5 or 10 years of the capital gains tax regime anyway, while Christchurch is being rebuilt. So we come to the third advantage, which is that it will encourage a different investment behaviour by New Zealanders. Now, as a nation, our investors have a love affair with real estate. And traditionally that has not been considered to be ideal by most economists. Those economists would prefer to see us investing in growth businesses and expansionary projects. Well, the difficulty with that is there are not so many of those expansionary projects around, and they all come with an acknowledged higher degree of risk. Now, New Zealanders have never been great risk takers with their investments, and we can be confident that that attitude of not being a great risk taker has been reinforced after the sad experiences of large numbers of New Zealanders over the last 2 or 3 years, losing so much of their invested funds in the finance company debacle after the world international financial crisis. Proponents of capital gains are touting this advantage. When they tout this advantage, they make the point that numerous other countries, and specifically Australia, the UK and the USA, have already got capital gains taxes. Now, I note that there are recent studies that may be discounting this claimed advantage, and as evidence of that, those countries have been much harder hit in their property sectors during the recent financial crisis around the world than in New Zealand, where our damage in the property sector has not been nearly as great. So perhaps there is some justification for our love affair with residential real estate after all. The fourth claimed advantage of capital gains tax is that it will lead to more affordable housing for new homeowners. This is apparently going to come about because there will be less people buying houses for residential property investment, and therefore a consequent reduction in demand for housing, leading to a reduction in price. Now, it seems a bit naive to me that in a market as complicated as real estate, that will actually come to pass. We know that there's an acknowledged shortage of houses in New Zealand right now. And the proponents of this argument have not at any stage made any reference to the increasing cost of house construction. So how they think that there may be a lower price just eludes me. The price of housing will be fixed by supply and demand. Yes, I agree with that. And it is conceivable that in the longer term there could be some reduced demand, but until the deficit in the currently available national housing stock has been eliminated by the construction of new houses, I don't think that fourth advantage is likely to hold water. So in the final analysis, in my view, these claimed advantages are not really advantages at all. Indeed, there may be some negative aspects to the introduction of capital gains tax, which is not at this early stage of the debate getting any mention. So what are some of the other issues with the capital gains tax? Well, acknowledging again that we don't really know any details yet, what's planned yet, it seems to me distinctly possible that contrary to the argument of the proponents, housing rentals are likely to rise and not fall. Look at it this way. Existing owners of residential property, that is, investing owners, are less likely to sell if they have to pay a capital gains tax based on their selling price. But those same people relied for a realistic return on their investment on an increase in the value of their property. Over time, if that increase in value is now going to be taxed, they will need to balance the return on their investment in some other way. The only obvious way is to increase the rental being charged. Now, I can imagine that the thought of that might disturb the proponents of the capital gains tax scheme, but I won't go any further with that one. My greater concern is that there are a huge number of complexities involved in any capital gains tax scheme. On the limited information available to us at this stage, it's already been announced that the family home will be outside the scheme. Well, I think that's obvious, but what about the batch or the holiday home? What about the other capital assets that people may own, such as company shares that we're supposed to be redirecting our funds to as an alternative and in favour of residential property investment? What about all of those other things? What about the painting on the wall that may suddenly turn out to be a Goldie? More important than that even is how's the tax to be calculated, collected, policed. I can see that we're going to be adding another layer of bureaucracy. We'll be adding and accumulating still more compliance costs for the average New Zealand citizen, and more especially for the country as a whole. As an example, if I owned a residential property, and by the way I don't, will I have to pay capital gains tax every year? One would assume not. But when I choose to sell that property, will I be taxed on the difference between what I paid for it and what I've sold it for, or some other basis? I'll come to that. And if it is the difference between what I have paid for it and what I sold it for, what about my costs of buying it and selling, the lawyer's fees, for example, and what about the cost of any improvements that I've made to it over the period of time I've owned it? And even more importantly, what about the effect of inflation over the period of time that I've owned it? Justice and equity suggest that there should be an inflation adjustment deducted from the nominal gain before the tax is applied. In any event, I think you'll get the idea that there are going to be a huge number of complexities there. Now, another concern I have, there have been at least 3 government-initiated or government-sponsored study groups in the last 15 or 20 years that have looked at whether New Zealand should have a capital gains tax, along with other things they've looked at. I agree. The first 2 of these bodies or organisations were flatly against the idea, and only the more recent tax working group advocated it, but in that case it was as a possible source of alternative revenue, and I've already talked about what the government did about that. In the McLeod Committee report, they were not only flatly against it, but I understand that the chairman of that, Mr. Rob McLeod, has in the last little while come out against the current proposal. So he clearly hasn't changed his views. So where to from here? Well, it'd be interesting to see how the debate unfolds. My personal concern is that the focus is on the residential property owned by Mr. and Mrs. Average New Zealand, and they, frankly, have already been dealt to in the 2010 budget. I'm personally not convinced that the argument that we invest too much in real estate is a bad thing. This is New Zealand. Although we tend to compare ourselves to other countries, we're a very unique nation, and we do have our love affair with real estate. Overseas experience suggests that when capital gains taxes come in, there's a tendency for the population at large to adopt what is called the palace syndrome. That is, because the family home is the only thing that's exempt from capital gains tax, the owners of the family home will pour their surplus monies into a bigger, better, expanded and more luxurious family home. Now, that would not support the claimed advantage of redirecting investable funds into a more value investment in the national economy. Interesting times, and it's going to be very interesting to watch how this unfolds. Thank you for watching.